In one single week, $32 billion disappeared. Not because of a market crash, not because of a war or a recession or a hack. It disappeared because customers stopped trusting the company holding their money. And within days, that company didn't have it anymore. This is the story of FTX. And the most disturbing part isn't that it failed, it's how long it looked completely fine right up until it didn't. This is the story of FTX, once one of the largest crypto exchanges in the world, founded by Sam Bankman-Fried. At its peak, FTX looked like the responsible adult in a chaotic industry, backed by major investors, praised in interviews, trusted by millions of customers who believed their money was safe. The pitch was simple: crypto is risky, but FTX is the safe place to trade it. But here's where it gets interesting. The company selling that safety was deeply, quietly connected to a trading firm called Alameda Research. And when confidence cracked, FTX ran straight into one of the oldest rules in finance: liquidity is trust. When trust disappears, the money goes with it. Sam Bankman-Fried didn't look like a Wall Street billionaire. No suit, no polished banker persona, just messy hair, shorts, and a calm way of explaining huge financial ideas like they were simple puzzles. Before FTX, he worked at Jane Street, a major quantitative trading firm. In 2017, he co-founded Alameda Research, a crypto trading firm built to exploit pricing gaps in digital asset markets. 2 years later, in 2019, he launched FTX, an exchange built for serious traders with the futures, leverage, and risk tools that crypto's Wild West was missing. It worked. Crypto was booming. Traders wanted speed. Institutions wanted access. By January 2022, FTX had raised $400 million in a funding round that valued the company at $32 billion. Major venture firms backed it. To the outside world, that looked like validation. FTX wasn't just another crypto startup anymore. It looked like a financial institution in the making. But there was one problem nobody outside the company could fully see. This next part sounds technical. It isn't. It's actually the simplest explanation for the whole collapse. Alameda Research was a trading firm. Its job was to make bets and take risk. FTX was an exchange. Its job was to hold customer money and match trades. In a healthy financial system, those two jobs stay separate. The exchange stays neutral. The trading firm bets its own capital, not its customers. FTX also had its own token called FTT, part loyalty perk, part tradable asset. Here's the detail that matters. FTT became a major asset on Alameda's own balance sheet. On November 2nd, 2022, CoinDesk published a report citing a leaked Alameda balance sheet. It showed the firm holding roughly $14.6 billion in assets, and a huge chunk of that wasn't cash. It was FTT, around $3.6 billion of unlocked FTT, plus another $2 billion in FTT used as collateral. That mattered because FTT wasn't like cash or even Bitcoin. It didn't trade in a deep independent market. Its value was tied directly to confidence in FTX itself. So if people lost faith in FTX, FTT would fall. If FTT fell, Alameda's collateral would shrink. And if Alameda was this tightly wound into FTX, Alameda's problems would become FTX's problems too. It was a loop, and loops like this hold up fine, right up until something forces everyone to look at them closely. On November 6, 2022, Binance CEO Changpeng Zhao posted that his exchange would sell off its remaining FTT holdings. This wasn't a random investor cashing out. Binance was FTX's biggest rival, and FTT was supposed to be a symbol of FTX's strength. Hours later, Alameda's CEO, Caroline Ellison, tweeted an offer to buy Binance's entire FTT position at $22 a token, a number that in hindsight looked less like confidence and more like panic. The market read the signal instantly. If the people closest to FTX were scrambling, what did that say about everyone else's money? Customers started pulling funds. Fast. In traditional banking, this has a name: a bank run. It's the moment depositors stop asking, "Is this institution healthy?" and start asking, "Can I get my money out before everyone else does?" That question is lethal because even a genuinely strong company can break if everyone demands their cash on the same day. Reports at the time put customer withdrawal requests at roughly $6 billion over about 72 hours. On November 8th, Binance signed a non-binding letter of intent to acquire FTX. For a few hours, there was a lifeline. Then Binance looked at FTX's actual books and walked away the very next day. By the time the market understood what that silence meant, it was already too late. This wasn't really a crypto story. It was an old financial problem wearing a new costume, using fragile assets to back urgent promises. Picture a marketplace holding your money with the assumption it's available whenever you want it. Now imagine part of that money is tied, directly or indirectly, as to a trading firm making risky bets. When the bets work, nobody asks questions. When markets turn, that firm suddenly needs real cash fast, and if its collateral is illiquid, like a token that only trades well when people feel confident, it can look solvent on paper and still be unable to pay anyone today. That's the difference between solvency and liquidity. Solvency means your assets are worth more than you owe. Liquidity means you can actually hand over cash right now when someone asks for it. A company can look perfectly fine on a spreadsheet and still collapse in days if its assets can't be sold without destroying their own price. FTT made this worse because the loop was circular. FTX propped up FTT, FTT propped up Alameda, and Alameda was wired straight back into FTX. It's like a house where the walls, the roof, and the foundation all lean on the same wooden beam. It looks fine until that beam cracks. On November 11, 2022, FTX filed for Chapter 11 bankruptcy. Sam Bankman-Fried resigned as CEO that same day. John J. Ray III took over, a name that mattered because Ray had previously overseen the wind-down of Enron, one of the most infamous corporate collapses in American history. His first public assessment of FTX was blunt. He described it as suffering a complete failure of corporate controls. That sentence changed the entire story. Before bankruptcy, this looked like a liquidity crunch. After it, the question got darker. Where had the customer money actually gone? U.S. prosecutors and regulators later alleged that FTX customer funds had been diverted to Alameda Research, and that Alameda received special treatment most customers never knew about, including access to a credit line funded by other people's deposits, and exemptions from the platform's normal risk controls. In other words, Alameda wasn't just another user of the exchange, it had privileges, and those privileges were hidden. Crypto lenders and trading firms with exposure to FTX came under immediate pressure. Confidence in centralized crypto platforms cratered industry-wide. For years, crypto had positioned itself as the alternative to opaque, fragile traditional finance. Now, one of its biggest names had failed for painfully familiar reasons: too much trust, too little control, too many conflicts of interest. What followed moved fast by legal standards. Bankman-Fried was arrested in the Bahamas in December 2022 and extradited to the United States to face charges. By November 2023, a jury convicted him on 7 criminal counts, including wire fraud, securities fraud, and conspiracy. 3 former lieutenants, Caroline Ellison, Gary Wang, and Nishad Singh, had already pleaded guilty and testified against him, walking the court through the internal mechanics most outsiders never saw. The picture that emerged in court was very different from FTX's public image. Prosecutors laid out how customer funds were used to prop up Alameda, repay lenders, fund luxury real estate purchases, and back political donations. In March 2024, Judge Lewis Kaplan sentenced Bankman-Fried to 25 years in prison and ordered him to forfeit $11 billion. He maintained he hadn't committed fraud, just made bad bets and mistakes. The jury, and later the courts, didn't see it that way. In June 2026, a federal appeals court rejected his appeal outright, upholding both the conviction and the sentence. For crypto, this wasn't just one founder falling, it was a credibility crisis for an entire industry that had bet its reputation on FTX being the trustworthy one. The recovery effort turned out more complicated and, in dollar terms, somewhat better than almost anyone expected at the time of the collapse. By 2024, FTX's bankruptcy estate projected it could eventually recover somewhere between $14.7 and $16.5 billion for creditors. But there's a catch most headlines missed. Customer claims were valued using crypto prices from November 2022, right at the bottom. Bitcoin and Ethereum both rallied hard in the years after, so even customers who technically got back more than 100% of their claims' dollar value may have still lost the upside they'd have kept if they'd simply held their coins themselves. Caroline Ellison was sentenced to 2 years in prison for her role and cooperation. Other executives faced their own separate legal outcomes. Across the industry, regulators got more aggressive, investors got more cautious, exchanges came under real pressure to prove their reserves and separate customer funds from company assets, basic safeguards that, in hindsight, should have existed from day one. FTX gets remembered as a crypto story. It isn't really. It's a risk management story about what happens when trust gets treated like capital, when a company's own token becomes part of its financial foundation, and when conflicts of interest get buried under technical language nobody questions. The lesson isn't that innovation is dangerous, it's that innovation doesn't repeal the old rules of finance. Liquidity still matters, leverage still matters, governance still matters, and customer money was never supposed to be a flexible funding source. FTX collapsed in days because confidence vanished in days, but the conditions for that collapse were built years earlier. In the end, it wasn't one tweet, one report, or one bad week that brought it down. Those were just the sparks. The real failure was the structure waiting underneath the whole time, one that looked modern and revolutionary, but failed for one of the oldest reasons in financial history. People trusted too much and asked too few questions. If you want more untold stories of market crashes, hedge fund blowups, and Wall Street disasters, subscribe to Wall Street Untold Stories. Because in finance, the biggest lessons are usually hiding inside the biggest collapses.